Good morning. It's anti-boredom month, so for each day in July, I'll share a joke to make you laugh, or a pun to make you sigh. To give it a try, just say, tell me the joke of the day. Getting your flash briefing. In weather, right now in Ocala, it's 24 degrees Celsius with clear skies and sun. Today's forecast has some sun and thunderstorms, with a high of 32 degrees and a low of 21 degrees. From CNN.
You always want the best for your family. And that means only Eggland's best eggs in your kitchen. Compared to ordinary eggs, Eggland's best eggs contain 6 times more vitamin D, 25% less saturated fat, more than double the omega 3s, 10 times more vitamin E, and more than double the vitamin B12. So why give your family less when they can have the best? Add Eggland's best superior nutrition to your next grocery list. Better taste, better nutrition, better eggs.
Good morning, everyone. I'm Kate Baldwin. It's Wednesday, July 1st. Here are your 5 things. Number one, the heat. More than 50 million people are looking at triple digit temperatures and what's likely to be an unusually long stretch of dangerous heat this week. In places like New York and Washington, D.C., it could be the hottest it's been in more than a decade. D.C. is forecast to hit 102 degrees on July 4th. The current record in D.C. for that date is 100 degrees, and that was set back in 1919. Philly and Boston also expecting records, with humidity playing a leading role in many spots, helping to push the feels like temperatures toward 110 degrees. Ugh. And so people are pitching in to help in big ways. A man in Chicago donated more than 30 AC units to people in need, including a family with a 4-month-old baby. New York is deploying a fleet of what they're calling cool vans to offer water, medical care, and rides to cooling stations.
We are activating more than 2,200 Link NYC kiosks to display real-time directions to the nearest NYC cooling center within a 10-minute walk.
So prepare. This is only beginning, guys. Number two, the birthright fallout. Facing defeat at the Supreme Court, President Trump is trying a pivot, you could say. The Supreme Court yesterday stopped his effort to end birthright citizenship through executive order. So now he's calling on Congress to start today on legislation to end what has been enshrined in the 14th Amendment. The president arguing that a constitutional amendment, though, is not needed to stop it. The Justice Department is also making moves, now directing U.S. attorneys across the country to prioritize investigations into so-called birth tourism schemes. No government agency tracks this specifically, so estimates range between 9,000 and 70,000 babies born through birth tourism each year. That's considered quite small, though, still, considering there are around 3.5 million births in the U.S. each year. Vice President J.D. Vance also weighed in.
I hate to call it birthright citizenship. It's fundamentally a loophole that now exists in our immigration system that rewards illegal aliens just because they have a baby in the United States.
Number three, the crypto windfall. Annual financial disclosures are required from every president by law. And the latest one from President Trump is a doozy, showing that he took in billions of dollars in his first year of his second term in office. The money pouring in from a whole host of cryptocurrency, royalties, and property investments. $526 million alone came from sales of crypto tokens tied to World Liberty Financial, a firm managed in part by his sons, Eric and Don Jr. The president made another $635 million from a licensing agreement with a company called Celebration Coins. That's the entity linked to Trump's meme coin business. Yeah. Then there's $77 million in resort revenue from his Mar-a-Lago club in Florida. And the list goes on from there. Trump watches brought in nearly $5 million, nearly $200,000 from selling Trump-branded Bibles, and more than $1,000 from secret including crypto president. This all adds up to yet again unprecedented territory for a sitting president. But the White House defends this ballooning wealth, saying that it's not actively involved in and denied any. Number four, the GLP-1s. Starting today, Medicare will start covering the cost of the now new wildly popular weight loss drugs for the first time. It's a pilot program and would cut the cost for prescriptions like Wegovy and Zepbound from hundreds of dollars a month to just 50. By one estimate, nearly 4 million people could receive this benefit. You do have to be enrolled in a Part D drug coverage plan to qualify, and you're automatically eligible if your body mass index is 35 or higher. If your BMI falls between 27 and 35, and you have an underlying condition, you can also qualify. If you're already on a GLP-1 for diabetes or other approved conditions through Part D, you won't be eligible for this new program. Now, manufacturers say that they have plenty of supply, but for what could now be a huge surge in new prescriptions of these meds through 2027, which is when the pilot program is slated to end. Stick around for more.
I'm CNN tech reporter Claire Duffy. This week on the podcast, Terms of Service, pretty much all of us are dealing with a problem that's become the background of our everyday lives. Emails. So many emails. Wirecutter senior staff writer Caitlin Wells set out to do something about that. She joined me to talk about her journey to manage her inbox, and she has some tips for how you can manage yours.
I treat my inbox as a running to-do list.
Mm-hmm.
So unfortunately, it's never going to hit the 0 mark. Many email clients now have it where you can just hover over the subject line of an email and a little button will pop up that says unsubscribe. And it'll send an email on your behalf, similar to the unsubscribe services that I tested, asking you to be removed.
Listen to CNN's Terms of Service wherever you get your podcasts.
One last thing. What? The World Cup since
Stop trading.
Sports fan
Night.
left behind. Norwegian
Last night.
Holland just punched his team's ticket to the round of 16 with a goal in minutes of game against Ivory Coast yesterday. But the 6'5" striker, it's not just
On it.
his skills that are turning. He's also turning heads. Well, also first luscious locks, but also now there's more.
I cut short though from like 3,500, I think it was.
Insanely impressive collection of uber high-end bags throughout the.
Don't ask me why. I went long on my personal too.
The way one lifestyle mag put it,
So I was damn.
competition's biggest luxury style icons, thanks to an extraordinary collection of Hermes Birkin bags worth, they say, more than $317,000. But he's also not alone. From Messi's Hermes to basically the French team's arm candy, World Cup athletes this time around are having some fun and seem to be redefining where the intersection of fashion, masculinity, and football or soccer, whatever you want to call it, is. So consider me green with envy. I think this is 5 things you need to know to get your day going.
I didn't know what that.
The United States is about to mark its 250th anniversary.
And so, on the Global Story podcast from the BBC, we're telling surprising tales of American influence on the world stage and in ordinary people's lives all across the globe.
We have this ability to export our story, and a lot of people have bought it.
I feel like the American dream is alive but not well.
From the BBC, it's the United States at 250.
Listen wherever you get your podcasts or find us on YouTube.
Hey, I'm Anderson Cooper. On my podcast, All There Is, we explore grief and loss in all its complexities. Wherever you are in the world and in your grief, I'm glad you're here. My guest is actress, writer, artist Sharon Stone. When you think of grief, what do you think of?
I think of the way that I've dealt with it in my life, losing so many members of my immediate family. I think of it with a very open heart.
You came very close to die.
Yeah. Yeah, in fact, some would say I did die and was defibrillated and brought back. I had that white light experience, which has stayed upon my shoulder and made me feel quite...
Computer, shut up. Computer, do you have news by CNBC?
In CNBC.
U.S. markets are up across the major indexes in Tuesday trading as the Dow notches its best first half of the year since 2021. As for the broader market, 7 of the 11 S&P sectors were lower on the day. Real estate was the biggest decliner, while tech was the best performer on the strength of chip stocks. SanDisk led that rally. The memory chip stock led all gainers in the S&P, up 10% after a multi-day sell-off in the sector. Semiconductor company KLA Corp was close behind, up 9% on the day. And NVIDIA, the world's most valuable company, was up more than 2%. Tuesday marked the end of the second quarter and wraps up the first half of the trading year. The Dow is up 8% in that time. Same with the S&P, and the tech-heavy Nasdaq has done even better, rising 11% since the start of the year. For CNBC Business News, I'm Julia Borsten.
This is the last story.
Computer. Open YouTube.
Here is YouTube.
Go to Meta EMA tab right there. Want to give it a try? Oh. Just because I'm technically buying here. Technically bought at the 15 EMA. Now we get a little bit of a pullback. It's going to be fire. It's like we done though. Yeah, bitch. Do it. I was supposed to wait till 10 for news, but you know, balls. No fucks given on this account, actually. Which one is this? 20. This one had profit? Oh, yeah, it did. This one had profit. Womp womp. Oh, this is no bueno. Jesus, take the wheel. Yeah. Fed rate? There's no Fed rate.
Let's see.
Oh, it's such good vision.
Oh, Warsha speaking.
Because there are large antiques in your area, there are drivers in your area. Uber.
Personally, I'd go with Sparkle. It cleans everyday messes and it won't clean out your wallet.
Add to cart.
30 flat I started getting in. That was stupid as fuck. Thought it was like 30.
Communications tools, if our models, if the way we've been playing things makes it harder for us to go into these meetings, have a family fight with our colleagues, make the best decision in pursuit of our mandates, if that's an obstacle, we should get rid of it. It is said in recent weeks, well, we need to know more about your action function. If I look at trigger pullers, people that are making decisions in the bond market, range of markets, volatility is not up, it's down. Yields aren't up, they're down. Inflation expectations are down. So I hear this that as if people don't understand. I think they actually understand quite well. I feel incredible comfort that I'm not sure I had internalized, that there is a willingness by my colleagues in the central banking community around the world to go back to first principles. We all want to make the best decisions we can. We've all been burdened with many of the policies that in some sense the Fed created in the 2008 financial crisis. This is a rare moment for us to go back to first principles, ask hard questions, review what we're doing. At the Fed, we've got 5 outside task forces to shed new light on this. And I'm encouraged because in some sense, we each think we're making our own monetary policy, but each of our monetary policies affect one another. And I'm honored to be on a stage with 3 colleagues who have been in the fight for 15 or 20 years with me and without me. And I won't at all be surprised if 6 or 12 months from now, each of us are on a better path to deliver on what we've said we're going to do.
Who's leading these task forces?
We have news to come. I can tell you likely next week who will be the outside experts. Some of them would have been folks in seats like this in prior years. Some would have been academics in the audience. But we really tried to find the best minds in economics profession among practitioners, people experienced hands, including people from countries outside the US. We're not asking for de Tocqueville to come to America, but sometimes we need a foreigner to sort of see things clearly. And the idea of these is not to prejudge the outcomes. I'm certainly not going to do it. But I think as we make progress on this, I think some of the lessons learned might not just be for the American central banker who's new to this crew, but my colleagues on the stage.
I was going to volunteer. Task force.
At the ECB, we went through the same process. And when we started the strategy review, it takes time. And we did bring under the leadership of Philip Lane, our chief economist, it did take time to bring we didn't call it task force, but we had expert committees, we had groups, and it took a couple of years before we actually settled down and all agreed on the key principles, the reaction function, the elements that we would take into account, the measurements of the nature of the supply shocks and the origin and blah, 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 blah. It doesn't happen overnight. It's complicated. It sounds simple when
they're buying time. Soulless Seduction in the chat says, Kevin, damn, I missed the notification. Folks, YouTube is not going to give you every single notification, even if you hit the button that says, give me all notifications. It's a scam. They will only give you 3 in 24 hours. If I post 6 videos and 2 live streams in 24 hours, you will miss more than half of the notifications. You could solve that by downloading the Meet Kevin app, and you could customize the notifications. Let me know when you're live. Let me know if you post a Fed video, but if you post a pilot video, I don't want it. You could literally customize the video notification like that in the Meet Kevin app. And you could use the Alpha Wire for free for now, which is kind of cool because the Alpha Wire is really good, especially if you're a trader. And that's free. Go use it.
We were at 2% interest rates. I think the Fed was at 350 thereabout, and you were at 355. Inflations were at different levels as well, and markets were expecting cuts in various corners. So it's the situation was.
Here's the wire service, just a quick sneak peek as to what it looks like on the phone. It's really cool, minute by minute news, and some of the news too. Breaking news comes through as red.
wild swings. And I mean, the dollar yen, for instance, is at the highest level in 40 years. Is that okay, Chairman Moore?
Well, before we came here, we each told a small story about Governor Wada, who's been a great colleague of many of ours, and we're rooting for his good health so that he can join us on panels like this in a couple of months. If this central bank stands for anything, it's staying in its lane on monetary policy. So do you think I'm going to wander into yen policy in Japan? You're way too much of it.
Well, it's making a move. That's all. You know, Governor Malcolm, on the markets, you recently, I think, warned about excess, just given the AI trade speculation. I think that's very much on the market's mind. Do you see signs of that? Thinking of irrational exuberance of the late great Alan Greenspan.
Yeah, we've been warning really of two things, and I'm gonna draw Andrew into this. Andrew chairs the Financial Stability Board. I chair the Vulnerabilities Committee. So, I mean, you know, as governor of the Bank of Canada, I'm looking at this from a Canadian perspective, but at the FSB, we're looking at it from a more global perspective. And yeah, I would highlight a couple of vulnerabilities. You know, as we've already said, look, there is so much potential to raise productivity growth with the adoption of AI, with the diffusion of AI. But there, you know, we've seen this before in when there's a new breakthrough technology. I mean, the internet proved to be, you know, better than anybody imagined, created whole new businesses. But we still got the dot-com bubble. It doesn't mean there can't be a period where the market gets ahead of itself and you see a retrenchment. So look, it takes two sides to make the market. We're not in the business of giving investment advice to the central bankers. But you know, from a financial stability point of view, you look at the sort of, you know, historical benchmarks, PE ratios, forward ratios. Yeah, things look stretched compared to those. So that doesn't mean there's a problem, but it does mean you need to take that risk on board. The other risk we've been highlighting is we've seen very large growth of hedge funds in the sovereign debt market, and to some extent, that's been very welcome. They've been very efficient in buying and distributing government debt. There's lots of issuance out there. Governments need investors, but a lot of this is being done with a lot of leverage, very short-term leverage, and that does make you a lot of it overnight in the repo market. And that does make you nervous that if there was a period of volatility and haircuts in repo markets went up, or there was some disruption in repo markets, you could get a rapid unwind. You know, again, part of our job is to sort of market.
And what's going on with leveraged ETFs right now? It's crazy.
They have a harder time seeing the systemic risks. These trades are very low risk for each hedge fund, but when they're all doing something similar, there could be a systemic overlay. And the idea is if we could point that out, the market can guard against that risk.
So, yeah, I mean, look, Kevin has referred to the financial crisis a few times, and he's absolutely right to do that. And one of the big questions at that time, or before it, was, is the subprime mortgage market going to be the trigger and the cause of a wider financial crisis? And, you know, we didn't get that call particularly right, frankly. The thing that we have to bear in mind is what we're trying to look for here is sort of tail risk. You know, is there something in these markets that could trigger a wider consequence in terms of financial stability?
Yeah.
And that's, as Tiff said, that's what we're trying to do. You know, Tiff leads the work in the Financial Stability Board globally to do that. So, yeah, we're absolutely right. So
these guys are probably telling all these concerns to Warsh too at this event.
Changed substantially. I think the thing we've seen actually in the course of the last few months is an increase in leverage in equity markets. So you look at hedge fund leverage in equity markets, you look at leveraged exchange traded fund markets, those things are changing. If you look at private credit, you know, the questions we're asking is, are those the things that actually can move from tail risk into a broader consequence? So then you have to say, what are the channels through which it can happen? So at the Bank of England, we're doing a second system-wide exploratory scenario to ask that very question about private credit.
Yeah,
that's our job.
Do you see any other broader risks emerging? And do you agree with the characterization of stretched for the market?
So look, I mean, we are looking, obviously, yes, we do look at asset valuations because you are living in a world. I mean, you've seen this obviously over recent months where you've got quite a divergence between how, bond yields are moving and how equity markets are moving. Now, I think a lot of this comes back to what Kevin was saying about AI. I think it's explicable in broad economic terms. But the question is, is that going to lead to some wider stability issues? So that's on the list. And then going back to what I was saying, I didn't want to reopen it again, but frontier AI is obviously high on the risk as well. So we've got quite a list of things that we're looking at the moment.
I wonder if you, Chairman Warsh, see any signs of excess trillion-dollar IPOs, high margin.
Just say SpaceX.
Other things that are going on in this market that remind you of those other times.
No, don't give that.
I'd say I've been out of this business for 15 years, but I still have the scars from the global financial crisis. I expect my colleagues do too. We take risks seriously. And that's part of the reason why each of us, I think, at the core have sort of a reformer's heart on this. What can we be doing in the conduct of monetary policy? How should we be revisiting fundamental reforms to supervision and regulation? How should we think about the payment systems that connect us all? So this conference is principally about monetary policy. I must admit, my first 4 weeks at the Fed, my attention's been focused on monetary policy, but our governments have tended to give us larger jobs than that. We take it all very seriously. I'm not prepared to sort of make a broad comment denoting risks that are available in the system, but I will say this. This is the biggest time of consequence to each of our economies, I think, in our lifetime, maybe absent the shocks of 2008 and the COVID shocks, the dramatic change in how businesses do business, how households are thinking about employment and inflation. And so this is a time we have to go back to first principles. I know at the Federal Reserve with my colleagues, many of whom are here, we're doing that. So I don't want to sound complacent. At the same time, I do want to say, at least for the United States, this is a time of huge opportunity. If the Fed can deliver on its remit to deliver prices, I've never been more optimistic about what the growth engine of the U.S. could produce.
The growth outlook of the U.S. economy this year is.
We're playing Mad Libs now. So I would just say this. Over the last 4 quarters in the U.S., structural productivity is in the high 2% range. So potential growth looks like it's trended up. This is a time that the labor markets, hours worked are relatively flat. History says that we go from periods of low productivity to periods of high productivity. Nothing is in the bank at this time of consequence. But if the last 4 quarters are an indication, which is really largely before the advent of the new surge in what artificial intelligence can do, I think there's reason to be optimistic. Now, does that optimism convey into policy in the next 6 or 9 months? Still too soon to say.
But strong outlook. Sounds like
you're back to forward guidance. No, I'm going to disabuse you of trying to extract that. My view, and my colleagues, I think, have said this better than I. My view is financial markets and the real economy work best when you look at what's happening in the real economy. You make your own judgments. There has been a tendency, and I take plenty of blame from this, the 08 crisis, where we were trying to suppress volatility, where we thought we needed to spoon feed markets to get out of that. That was the right policy for a crisis. It is not the right policy for the time that we have now. And so sometimes unlearning is harder than learning, and I'm going to keep at it.
Okay. So what are President Lagarde, how do you think about the best levers to boost growth in the Eurozone right now?
Capital Market Union, 28th regime, and boost the venture capital. Okay, so that would be on the growth front. But I would like to add one thing. Thanks to the veterans at this podium and a few other people, we have a strong, solid, robust banking system, which is strongly well-regulated, well-supervised. And I think we should be cautious about what we are throwing away by way of simplification. So we do simplify things, and I'm delighted that, for instance, the ECB has done away with 40 different sets of declaration disclosures that were unnecessary out of the 130 plus. So we have to go through that process. But I think we have to be cautious about how risks actually move. And risks were squarely in the banking system back in 2007-8 when we were all together fighting this global financial crisis. Risks travel fast, and there is no limit to the imagination of those in the financial sector who are trying to make money, as is their business, and who are taking risks. But the question is really who eventually ends up taking the risk and sweeping the mess. So I would contend that this regulatory work that we did at the time, we need to be very attentive, as Andrew suggested, to ensure that the risks that have moved and traveled afar through different structures, bodies, and the different names are also looked at carefully, and that the right measures are taken to protect the public good and to protect the principle of who takes risks bear the responsibility that goes with it.
The other big topic that I know that you all think about and is part of your remit is the balance sheet. Chairman Warsh, you had talked about before you became Fed chairman that the balance sheet was too big in the United States. So it's 6.7 trillion right now. What level would you be comfortable with?
No forward guidance.
No forward guidance, and I'm not going to give the balance sheet. Okay, we're just among friends. We have a task force for that too.
We're going to play drinking game on task force.
I'll say this: there is no.
I want to play.
From the 2011 period when I was leaving the Fed through now, I wanted the Fed's balance sheet to be smaller, and I long wrote about in squads. Interest rates should be the dominant means through which we make monetary policy. If we're in a crisis, there could be a different set of rules. It's always struck me that interest rate policy is the fairest of the broad constellation of our citizens. Interest rate policy, whether we move it up or down, transmits its way into new mortgage, credit card debt, transmits its way through a lending channel and credit channel. Always had a view that the balance sheet works mostly through asset prices, works mostly through signaling effects. My 4 weeks at the Fed haven't disabused me of that idea. As we're hearing an alarm, must be my way of saying that I've gone too far on the balance sheet. But we have a task force that you'll find out of outside people that are going to debate this topic, bring it back to my colleagues and me to see whether we can have a judgment about whether the balance sheet should be made smaller. The only thing that I'll repeat here, which I've said repeatedly, is if there's a change in balance sheet policy, it'll be a change of my colleagues in the FOMC and the board. Those decisions will be well deliberated publicly, well understood, and will not be implemented into financial markets. Have come to understand what those are. It took us about 18 years to find our way into this big balance sheet, which again, in my biased view, borders on fiscal policy. Took us 18 years to get out of it. It'll take us more than 18 weeks to bring it down to size. I'm open-minded on the question. We're not going to prejudge it, but I want interest rate policy to be the working oar for monetary policy.
Governor Bailey, you've been focused on the balance sheet. I guess at one point we were asking how big can your balance sheets get? And now I'm wondering how small they can get.
Well, look, there's a nice sort of sense of irony I appreciate from this conversation because I've been accused of having too big a balance sheet and reducing it too quickly. So, well, really. So can I go back to forward guidance for a moment because I've really eschewed forward guidance on the balance sheet. So I really don't step into this what I was saying. We want ample reserves. We want big reserves, small reserves. My line has always been, we will meet the system demand for reserves. Because that's the system demand for liquidity. By the way, understanding why the system wants the liquidity it wants. And also, the key other point, which Kevin has made very forcefully, is that's the way we actually implement monetary policy. Through the short-term interest rates, making out of our balance sheets into the.
Yo sé, I know.
And that works very well. So, our world is we will meet the system's demand for reserves. We will understand what the price is doing.
Abogado.
The other policy I have is take interest rate risk off the central bank's balance sheet.
Siéntate.
With a public.
Siéntate.
to be in the market on our balance sheets. And so that's why we're moving to a repo asset side of our balance sheet. That takes the interest rate risk off our balance sheet, which is what should be the case.
You mentioned that you alluded to the political heat that you get over this issue. Does that influence the way you think about it at all? I know it's not supposed to.
No, I think we must have a sensible policy for moving to a system where our balance sheet reflects the substantive demand for reserves. So yes, it went above that level during the QE period.
Le voy a cerrar la puerta.
I want the interest rate risk off our balance sheet. Those are the policies we're pursuing, and I think those are the right policies.
Do you get let off the hook on Macron because the prime minister being in this seat?
We get some free advice from elected officials across the country. And as I tell them, I appreciate understanding what's going on. It's a big country. I appreciate understanding what's going on across the country, but I don't appreciate telling me what we should do with interest rates. You've got your job, we've got our job, and that needs to be respected. So just come back to the balance sheet. Interestingly, if you compare different central banks, you'll see a pretty wide range of sizes. We didn't do QE in 08, 09. Fortunately, Canada, no banks failed. We did get a big shock, but it wasn't so big that we needed to invoke that emergency policy. We did use QE in the pandemic. It's the only time we have used it. But the fact that we only did it once meant that our balance sheet wasn't as big to start with, and we let the bonds run off, so our balance sheet has run back to its new steady state. And if you compare central banks, as I said, the size of the balance sheets can be pretty different. I mean, Canada's balance sheet as percentage, Bank of Canada's balance sheet as a percentage of GDP is about a third of the Fed's. Now, look, Canada's not the world's global reserve currency, so yeah, there might be some differences here. But I think the results of Kevin's task force is going to be very informative to us. And the other thing I'll say about balance sheets is it's a very inside baseball kind of discussion. It's not the sort of thing most Canadians are really that engaged in. But it does, it is how there is an element of how do we implement monetary policy? What is the demand for reserves? We've spent the last couple of days talking about new kinds of money. What do those potentially mean for our balance sheet? So these are questions we need some thinking on.
In the short time that we have left, President, let me get to you on this political point, and because you have been a forceful voice for central bank independence, you do so, and you, I mean, unlike these guys, you have to battle more than 20 different governments and leaders, 21. So you're a pro at that. I'm curious if you think that if you look out and see serious risks to central banks independence, especially in light of the Supreme Court ruling that we got in the United States, letting Governor Lisa Cook keep her job.
I think, the best way we can actually all do our jobs is to be number one, accountable, number two, independent, and the two come together. When I go to the European Parliament on a regular basis to report on what we do, to explain what we do, that's the counterpart for this independence that we have. Staying in our mandate, the entirety of the mandate is also the sine qua non condition for deserving that independence, which is a precious good, which we would not do a big job.
We were doing so well. I feel that the Supreme Court was so active independently and followed its remake after the Supreme Court ruling will continue to do so. Over here. One of the secrets of the
How much more? 30 seconds.
At the outset is because of the constitutional design in the U.S. It's the foundational element that has given us 250 years of outperforming expectations. I believe in Article 3 judges. I believe in the rule of law. We'll follow the Supreme Court decision, but day to day, the decision reaffirms what President Lagarde already said. We are calling balls and strikes as best we can. We're taking seriously the reform objective, and we're going to deliver on the high promise that Congress gave us to deliver price stability in the context of our dual mandate. And when we do that, we don't have to worry about politics. We don't have to worry about judicial intervention. We get to look in front of us because it's a challenging step.
Okay, we have a minute left, so I'm going to ask everybody one quickie for everybody.
A quickie.
Two quickies, actually. Bailey, I'll start with you. So, your favorite economic indicator right now?
Sorry, there.
Your favorite economic indicator right now?
Oh, that's a trap question as well. You see, that's a trap question. It's forward guidance. Yeah,
you brother.
Tell you what, I'll answer it.
Oh, there you are.
My inflation forecast.
Governor Bailey, you have to answer.
Well, look, we look at a whole range of data. Let's see, if you sat through our meetings, you would see more data than you could ever dream of. The other thing I say, look, I say this, I spend a lot of time going around the country and I talk to a lot of businesses, and it's absolutely imperative that we stay in touch with the economy.
President Lagarde?
Inflation outlook, balance of risk, underlying inflation, transmission of monetary policy. Thank you.
Chairman Warsh.
I guess I have the last word. With the new with the data project, the data task force, my hope, my aspiration is that 9-12 months from now, we're going to be using new technologies to understand what's happening in the real economy in a contemporaneous, real-time way that positions us as central makers to make better decisions. That we're no longer going to have to rely solely on data that we get from government agencies with mismeasurement problems that have surveys that are no longer relevant.
Wow.
Every business week
9 to 12 months
in our country are using new data sources to make better decisions. My favorite data is upon us. And if we do our jobs, we'll be here a year from now and we'll say we've discovered data that helps us make better decisions. And we live up to our promises, we strengthen our credibility, and politics stays at bay.
Least favorite economic indicator?
The conventional wisdom that we hear from time to time tells us nothing. Monetary policy works with long and variable lags, as we know, and many of these indicators are echoes of history. We need indicators that tell us what things are. We look out our window today, so when we make judgments when we next convene, they're as close to real time as possible.
I thought you were going to say the dots.
Yeah, right.
I'm going to let one panel discussion go without me sort of wagering on the dots.
He does want to kill the dots. That's why Sarah said that, in fairness.
At the very least, but we have a task force for that.
Yeah.
Do you have a least favorite economic indicator, President Lagarde?
What did you say?
Least favorite economic indicator. It gets too much attention.
Those that are wrong.
Shit. Stupid. Oops.
Help me out.
You know what I say is that especially a lot of the monthly data, it can be very volatile. And sometimes the market over rotates on the last
that much.
You gotta correlate it with other things. You gotta smooth it a bit. The last monthly number is never going to be the best indicator.
So I'll give you one that we're wrestling with at the moment and have wrestled with for years, as obviously relevant, which is oil and gas futures prices. So they are terrible indicators in history. The problem is that everything else is also a terrible indicator.
Very good. Finally, when we were coming into this year, everybody was talking about rate cuts. Is anyone still talking here about rate cuts? Show of hands.
That's a nice try at forward guidance.
All right. Thank you very much.
Dang. Okay, there's a lot to cover there and a lot to break down there. We're going to do a complete summary of this. Quick reminder, we have the Reinvest Homes AI is out. This is very, very early beta, but houses are now sorted by estimated gain, which is really cool. That's the House Hack tool. This whole app, by the way, is owned by House Hack. That's the real estate terminal side right here with the little house icon. And when you jump over to the other terminal, to the stock side, the little mountain graph over here, You get the data feed, you get the wire feed over here, you get our stock AI tool, which gives us forward guidance on price targets and what sort of the algorithms and AI that we've developed are looking at. So we're really excited about this, and we'd love to have you join us over at meetkevin.com or househack.com and yeah, join the membership. All right, let's get started with a full summary of what's going on here. All right, here we go. Well, we just heard the central bank forum at the European Central Forum, this being held in Sintra, Portugal. And we heard from Christine Lagarde, Kevin Warsh, Andrew Bailey, and Tiff over from Canada. We're going to break down what all of them have said. And I actually think there's a lot more color we got this time from Kevin Warsh. Sarah Eisen's pretty good, I think, at loosening these people up. Asking them for quickies. And let's just say, I think we got a little bit more out of Warsh today than we've gotten out of him from the last press conference. What's actually remarkable is you can immediately look at the bond market's reaction, the difference between the 2 and the 10. We can actually see that the 2-year yield has basically stayed flat here as the longer term yield is rising. Potentially a suggestion that maybe markets don't need to price in hikes as aggressively on the near term, but maybe that productivity growth will be stronger in the longer term, leading to a little bit of a steepener here on the 10-2. But a lot of color for us to look at. Looking at the bond market's reaction in the first 10 minutes is always a little kooky. Let's look at what was actually said. So, of course, we heard the classic, we don't want to talk about forward guidance, but then they basically spent the whole time talking about what they think their concerns are for the future and what the upside risks are for the future. So, both downside risks and upside risks. And I'm obviously going to start with Kevin Warsh on this, and then we'll circle back.
Watch me go stupid right now.
Kevin Warsh gave us some pretty good insight in that monetary policy spills over from one economy to another, he said. It's worth knowing that the European Central Bank is basically facing Eurozone growth that's near zero. You've got the Bank of England that's facing growth that's at like 0.5%. And you've got the Bank of Canada that's looking at growth that's like negative 0.5%. So all three of those economies are basically nowhere with GDP growth. And so if Kevin Warsh is like, yeah, our monetary policy spills over from one economy to another, I think what he's kind of implying is that all three of the other central bankers are going, Kevin, don't raise rates. You're going to screw us. To me, maybe that's too bullish of a read there, but that's what I'm gathering a little bit from what he's saying there. Now, maybe he's also implying that hopefully we could spread our productivity boom to these other economies. He says the following, which is also a good insight. He says, quote, the US AI shock is leading to a boom in demand first, and the supply boom will come. Wait a second. That's forward guidance. Holy moly. He's basically, this is like, we would understand that this is to happen, but for a central banker to say that bluntly is a way of saying, hey guys, yeah, boy, we have quite the inflationary boom right now because everybody's buy, but the supply side is going to come. And what happens when demand goes up and supply stays down? You should know this from Econ 101. Demand up, supply doesn't move. What happens to equilibrium price? Price goes up. That's inflationary. What happens when supply goes up to catch up with demand? Equilibrium price goes down. That's disinflationary. He basically used Econ 101 to tell us prices are going to come down. Then he tells us, by the way, we're working on new ways to measure inflation. In fact, he gave us a time frame. He didn't give us this last time. I think Sarah hosed information out of these folks. You just have to read between the lines a little bit. Sarah literally eked out of them the quickie that in the next 9 to 12 months, quote, we're going to use new technology, contemporaneous real-time technology to measure inflation and economic activity. We're no longer going to rely on older government data that's heavily subject to revision. Wait a sec. 9 to 12 months for your task forces to actually get something done? Yes, basically. Which is in alignment with what Christine Lagarde said about committees. See, Christine Lagarde literally and bluntly said, yeah, we didn't call them task forces. We used committees, but these take time. Time, in our case, was 1 to 2 years at the European Central Bank. Kevin Warsh just told us 9 to 12 months, and then we'll use this new way of measuring inflation. Well, in my opinion, he's not going to want to do anything until his task forces are done, which in my opinion means we might end up being stable with rates for the next 9 to 12 months, as long as there's not another inflationary shock, which in fairness, all of them also said that they're really grateful that oil prices have come down. Christine Lagarde said it's great that oil prices have come down. Kevin Warsh talked about how great it is that recently, over the last 4 weeks, inflation expectations have come down and bond yields have come down, which is another way of saying, the oil shock is over, which is good. In other words, hey, bond market's pricing less of a risk of runaway inflation, so we don't have to act as fast, right? All of this so far is in alignment when you put pieces of the puzzle together. And it makes sense because, look at oil prices right now. We just had WTI, the Western blend of oil, fall to $69. Too bad Sarah Eisen didn't talk about exactly where the oil price is, but whatever. Brent down at 72. That's good. That's that disinflationary pressure on, obviously oil prices, which were very inflationary recently, and they do eventually feed through to all consumer goods and services, which isn't great. When that pressure goes away, you can afford the central bank more time. And central banks know they can't really do anything about oil prices anyway. It's a supply shock, right? All right, fine. So, what else did we get? Because, in my opinion, so far, all of that is pointing to the same direction. But what's crazy is we also had them talk about the potential risks to broader economies and how a productivity boom works and what history tells us about productivity booms. This potentially has the R word built into it. We'll talk about that R word in just a moment. Do have to send a pitch though. Because we released this super late last night, our Reinvest Homes AI with House Hack, we did push the coupon just 24 hours to tonight for both the Meet Kevin membership and the Reinvest AI membership. I'm going to show you the actual app really quickly, but we're going to be updating the website here, and then we'll be raising the price a lot on both these products for Reinvest AI and the Meet Kevin membership. We extended that coupon to tonight. And we did that because we released the app update so late yesterday. And so we've got our Reinvest Homes AI app out, which is in very early beta, but we're very excited because it's going to sort properties. It already sorts properties by the estimated gain that you could get by buying them. And we'll slowly be releasing the negative gain properties as well, like the properties not to buy, which could be equally as important. But then inside our app as well, especially if you're a course member, we've got our Alpha Wire here. We've got our stock AI tool with price targets. Meta, by the way, is up 9% today. Our stock AI has Meta at a fair value of $1,377. Meta's up 8% today. I think Meta is scraping along the bottom. We've got all the Meet Kevin fundamental analysis in this, the algorithms that we use, the change that we see quarter to quarter. And these are really cool tools that you can get lifetime access to. After this video, by the way, we will be live in our course membership, which you can join every day as well. You get our alpha report, our private live streams, trade alerts, all 9 courses. And a lot of people say joining could be a tax write-off, so consider joining us over there. All right, so let's talk about central banks and this productivity boom. So Kevin Warsh tells us that productivity booms are broad-based, and they don't have to be zero-sum. Kevin Warsh tells us that we're in the first or second inning, and that this is a really big moment because it's a moment for us to consider our policy and where we are in relation to jobs, productivity, and the fact that Kevin Warsh believes that prosperity will be greater. But he says that there is a timing risk. He says it takes time for us to see the fruit
I'm trading
of
all of
AI.
them, really.
And that right now, he essentially says,
This was supposed to be the
why? Because he says
this was supposed to be
we're
the
in the
trip to celebrate.
stability business. Expectations of inflation have come down, and inflation risks have come down. Basically, we can afford to wait to see how this boom evolves. But where's the risk that comes up? Kevin Warsh says, quote, I still have scars from the financial crisis. I don't want to sound complacent. Potential growth looks like it has trended up, and we tend to go from cycles of low productivity to high productivity. And we have to study history to understand that. Okay, so that sounds pretty basic, right? That doesn't sound like there's forward guidance in that, right? But wait a minute. What does history tell us? You could ask any AI about this. You could ask any or read any book about this. What does history tell us about going from low productivity to high productivity? Two types of transitions. One type of transition is the late cycle transition to recession. That's basically where in the late cycle, you have low unemployment and companies tolerate waste and inefficiency, which is really interesting because remember the video we made yesterday about that ramp study? Remember this? If you didn't watch the ramp study video, you should really watch it. But here's that ramp study. They tell us that the earliest signs of employment growth are happening when companies start adopting artificial intelligence in the tech sector. But what that doesn't tell us is what happens when companies go through the cleansing phase. The cleansing phase is where companies go, crap, it's harder to raise money. It's time for us to be a little bit more productive. We need to lay people off. Well, what is the cleansing phase called when an entire economy goes through the cleansing phase and removes waste and inefficiency? It's called a recession. You can make the argument that the Bank of England, the Bank of Canada, and the European Central Bank are all already facing near certain prospects of a recession, that the US is the outlier for now. But once we get into the cleansing phase and you get layoffs happening and more has to occur with fewer people, that's when you get a global recession. We saw that happen with the the dot-com bubble, and we saw that obviously happen with prior economic booms, whether it was post-railroad or otherwise. Now, in fairness, history doesn't tell you that you're guaranteed going into a recession. You could boom like we did in the 90s, or we could boom like we did during the electrification of the roaring 20s, in part driven by the assembly line and productivity because of Henry Ford's assembly line, early part of the century. So Kevin Warsh pointing out history, in my opinion, is again a reiteration that says, hey, look, inflation risks are coming down. Our task forces are going to take 9 to 12 months to figure out which direction to go. In the meantime, we're going to wait and see what other data we can get to tell us, are we going to have a roaring 20s electrification boom where we go from low productivity to higher productivity, or are we potentially going to go from low productivity to high productivity through a recession? Both can happen, and we're going to be mindful of the scars of the past. So I think that's actually
Just smacking button, bro.
He's going to sit on his hands and wait for the data. Now, Governor
Today I
Bailey
have been
will go into some of
smacking
the other governors
buttons.
here because some of these sort of reiterate what Warsh is saying as well. Governor Bailey acknowledges they've got a softening economy. The output.
Well, that's the trade. Just stay in the short. Stay in the motherfucking short. Don't hit the motherfucking button.
He also tells us that there are tail risks that they're paying attention to, such as leverage in markets. He says that markets seem to be stretched.
Down, bitch.
They're analyzing private credit and financial stability matters because
Smack
there is
button
so
like a
much
motherfucker.
leverage system now that financial stability could turn really rapidly. Now that's interesting because it kind of tells us that Kevin Warsh should be paying attention to financial stability as well, right? When they're all on a panel together there. Look at this, for example. Leveraged ETF assets under management. Interesting. All-time highs. leverage ETFs had about $47 billion in assets under management
Fucking God.
for COVID. And those ran up to about $218 billion sitting in leveraged ETFs. This is why when we see a red day, the end of the day tends to accelerate down, or on a green day, the end of the day tends to accelerate up now. This is a phenomenon driven by leveraged ETFs having to buy when the market is going up, which is basically buying high, and then selling when the markets are going down, which is basically selling low. Leveraged ETFs are just amplifying bad investing. And so Andrew Bailey pointing out leverage in the system is very important. I mean, look at the concentration peaks we have in markets. Historically, we are sitting at a concentration peak. Nifty 50, tech and telecom, the Japan move, and then, of course, the big 10 stocks like NVIDIA that we're seeing right now. All of the concentration peaks peaked between 40 and 44%. Concentration peak we just had was 41%. So these are real risks, and the central bankers seem to be paying attention to those, which is great. Now, the Bank of Canada said that right now they're somewhat comfortable where they are at 2.25, which is about a 1.25% lower than where we are in the United States. And they argue that risks could shift quickly, that when inflation or disinflation arrives, we need to be humble about it. And I think he leans towards disinflation because they also talk about how great it is that oil is falling. And being humble about it means, hey, cutting rates. The Bank of Canada was really bearish on this idea of stagflation. They're like, no, we don't have inflation. Inflation expectations are low. We've seen this sort of stuff before. And we don't need to be worried about stagflation. Yes, unemployment is at 6.6% and inflation is at 3.2%, but it's nowhere near as bad as what we saw in the 70s. Christine Lagarde jumped right on this and she's like, yeah, no, we don't have stagflation. We have no stagflation. But in fairness, all of their economies are feeling like they're stagnating during a time we have elevated inflation. It's just not the inflation we saw in the 70s. And the reason they have to fight against that so hard is because they don't want to seem like they've lost control of inflation, which was done in the 70s. They lost control. Now, the Bank of Canada goes on to say that the internet proved to be better than anybody imagined, but we still ended up getting the internet bubble bust. And the market can get ahead of itself. Another little, elbow jab there to Kevin Ward, right? This is what I'm saying. Like, all of the other bankers who kind of like poking Warsh in the elbow, going, hey, man, things could poop the, we could poop bricks pretty quickly here. Anyway, Christine Lagarde, she is really excited about more balanced risks because of how quickly oil has gone down. She says stagflation is a concept stuck in the 70s. At least employment is still growing, but we've got to be mindful of the tail risks. And then we had Bailey, Andrew Bailey, who came out and said that, hey, we'll see what happens. The big thing that he said, we already touched on a lot of what he said, but the big thing that I wanted to go back to about him was how much he doubled down on how important financial stability is. And I think it's really interesting because when you zoom out and look at all four of these bankers together, you kind of have Kevin Warsh sitting there going, look, we're going to wait 9 to 12 months for our task forces to tell us what to do. All of the other governors are like, man, there are tail risks to the economy. Things could go bad. Valuations are stretched. There's a lot of debt. Boy, isn't it nice that oil prices came down. Huh. And so when you kind of bottom line it all, you had three people up there going, inflation is probably going to go away here over time. But our economy has real risks of overheating because of AI and potentially falling into a recession and the bubble popping. And then you have Kevin Warsh going, yeah, we're going to wait and see how all this crap plays out for 9 to 12 months. It's kind of all in the same place. So that's my breakdown of what was just said. I actually think this was much, much more insightful than what we got out of the Fed meeting. So now remember to go to meetkevin.com, join the Alpha membership. Keep in mind, because we have released the Reinvest Homes AI product, as soon as we update the website over here for Reinvest, we're going to be raising the price a lot on this product. We did extend the coupon to tonight. Ignore the fact that right here it says June 30th because that we did extend it 24 hours. So it'll still be active through tonight as we update this website. The product, the valuation update is out. It can now be downloaded for course members, which is really exciting. And what a lot of people are doing is they're joining over at Meet Kevin, and then they're bundling up their membership with the Homes AI, which is really cool. So anyway, thanks so much for being here. A really useful discussion, and we'll see you in the next one. So goodbye out there, and as always, good luck. And maybe we should do some more of these live streams. Yeah, leave a comment if you want some more live streams. We like the live streams. Oh, we gotta do this too.
Nice to have you. But you want to talk about lovemaking, right?
We're gonna have to pull more clips from Sarah.
Tiene un cojón de volumen y cero dirección.
You fucking pussy piece of fucking shit. In just 5 days, I made $50,000 profit. The profit. Stop. Stop. Not really. And that required me $2 million. So, how I made $45 million in 1 month. So, at the beginning of the month, I invested $200,000.
Cualquiera dirá que mi entry es un EMA y no joda. Yay. Yay. Can you just free fall like a motherfucker and pay me my money? Could I just leave? Uh, Guess what? Guess what? You're gonna go get a haircut all by yourself. Yes. Can you do it? Yes. Easy. Okay, Max, we're here. Haircut by yourself for the first time. For the first time. Okay. No. You're gonna go in there all by yourself and do it? Yeah. Honey, take my card. That's what you're gonna pay with, okay? Yeah. When I think about it every night, day, I know we think ours inside of me. I wouldn't wanna have it any other way. I'm addicted and I just can't get enough. 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 I wouldn't wanna have it any other way. I'm addicted and I can't get enough. I just 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 can't get enough.
Estoy tradeando como ICT. Sin seguir mis reglas y sin parámetro alguno de riesgo. Yo lo que quiero es pasar la puta cuenta hoy. O la paso o no me da mi daily loss. Ese es el trabajo de hoy. ¿Qué vas a hacer tu perrita? Ah, quieto. Y yo no estoy haciendo nada ahora mismo. Estoy reacio a toda la vida. Esa era, coño. Esa era, coño. Baja más, coño. Baja. Maldita, baja. Meto 10 más. Coge 10. Luego. Baja. Ahora sí, baja. Eso era. Baja más. Baja más, maldita. Esa era. Tú tienes que decir 53. Vamos a huevo. Baja más. 1.6, 1.7, dale. Give me more, bitch. Baja. Quiere decir 53, clarito. Como que pasa. Dale. Motherfuckers. Dale. Baja más, motherfuckers. Oh, na 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 oh, na 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 oh, na 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 oh, na 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 oh, na na oh, na 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 na. Baja como huevo. Baja como huevo, ay, rompe. Rompe, 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 niña, rompe, 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 niña, rompe, 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 niña, la cucú. Yeah, actitud, like, no, el que me quiere la actitud, daddy, daddy, go, daddy, go, daddy, go, go, yeah, que control, oh, sube ese temperamento, dale, movimiento, lento, lento, dale. Rompe, 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 mi llamo, rompe, 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 mi llamo, rompe, 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 mi llamo, let's go. Ajá. Iba bien. Iba bien. Mount Good, getting up, ¿ustedes escuchan el perro? No hay nadie viéndome, eso nadie le escucha, pero yo sé que se escucha. Tiene que escuchar clarito el animal este como jode. Bueno, no, eso no es lo que tú quieres. Esa vela dice lo contrario. Esa vela entera dice que tú quieres hacer un guatapanazo así para abajo, feo, feo para abajo. Ion, exacto, un guatapanazo feo para abajo, feo para abajo. Ahí fue. Oh, na na na, oh, na 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 na, oh, na na na, oh, na na na, oh, na 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 na, oh, na 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 na, na 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 na, oh, na na na, oh, na 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 na, oh, na na na, oh, na na na, oh, oh. Mm, mhm, 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 tengo una cuenta ya pasa, tengo una cuenta ya pasa. Vamos a ver qué hacemos con una mamá. Vamos a coger un break. Porque, o sea, look at all this bullshit, bro. Mírate esta mierda que yo hice aquí. Vamos a ver. Ahora la primera. Primera ni se ve lo que hice porque fue anoche. Ya, anoche fue. Esa mierda. Voy a aprender a tener cojones, a hacer esta otra. Yo quería longuear. Fue short. Esta yo la quería shortear. Esta estaba correcto. Esta yo estaba in the race. Pero empecé con el. Empecé con no sé qué. Diablo. Yo quería shortearlos todos. Yo los shorteé todos y todos me salieron mal aquí. No, esto fue longa. No, esa es la que estoy viendo ahora. No joda, mamá huevo, que mucho peleo y para hacerme esa mierda. Por lo menos pasé una cuenta. Tengo una PA. ¡Ey! Tengo una PA. Oh, na, 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 oh, na, 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 na. Quiero pasar esta, así a lo. Ya, vamos a parar. Vamos a parar. Oh, na, 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 oh, na, 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 na. Ustedes se van a quedar aquí.